Well, many people get the interest rates confused with the Fed, and the Fed is an institution, obviously, that's managing the overnight rates between banks. And so that has more to do with like credit card debt, personal loans, things like that. But a lot of people think somehow that they're tied with mortgage rates, and that isn't true. Mortgage rates, particularly the 30-year interest rate, that's the environment that most people want 30-year fixed rates. And so they're closely tied, however, to the 10-year Treasury, but not directly. So the easiest way to understand it is that if you think about mortgage rates and the 10-year Treasuries are like, two runners that are running side by side and they're tethered together with a rope. They don't do it in lockstep. But at the same time, when one speeds up, the other one speeds up. When one slows down, the other one slows down. And so that's like the dynamic that happens between the two. And that's the easiest way to be able to understand that. But how they're connected, and they behave in a couple of different ways. So for one, the 10-year Treasury is considered one of the safest investments that there is. And these mortgage-backed securities, also known as MBS, these are financial products that fund the home loans. And they must compete with other bonds in order to attract investors. So when the Treasury yields go up, the mortgage-backed securities also have to have higher returns to be attractive. So mortgage rates also go up at that time. But when Treasury rates fall, mortgage rates typically do, and that's that tethering of the two runners analogy. And so the 10-year is used because most people, even though they get a 30-year fixed rate loan, the average mortgage is paid off somewhere between 7 and 10 years. That could be because they paid it off. That could be because they refinanced that, or they sold that property and moved to a different property. So the most on average have been paid off in 7 to 10 years. So those rates are tied to the 10-year, not the 30-year bond. And so they move in opposite. So when a bond prices go up, the yields go down. And so what do you think is going to happen with these recent job numbers that have been revised down? And it looks like, oh, wow, the economy may not be as strong as they had originally thought because they're revising these numbers down. And the bonds immediately responded to this. And all of a sudden, the yields start diving a little bit, and the bond market's telling us that interest rates are going to be dropping soon. And so even with Powell deciding whether or not he's going to do it or not, he just recently did not raise or lower the interest rates, even though there was a couple of the members of the Board of Governors that want the interest rates lower, and certainly the President of the United States wanted to have bond prices in such a way that would drop rates, and that would help bring money into the economy. If the Fed did drop their rate, then your credit card rates drop down, car loans drop down. People will have more money in their pocket, and then they would put it back in the economy, and that's how that ends up boosting the economy a little bit. And so there's this delicate balance that the Fed has to try to normalize the rates so that the interest that people pay, if you want to discourage somebody from spending money, charge a high interest rate, and that'll slow things down. So when you see the Fed raising rates, they're trying to slow people down from spending money in the economy, and the vice versa is true. When they want the economy to be boosted, they will lower the interest rate so people would borrow more and spend more money in the economy. And so there's this delicate balance, and oftentimes they're a little too late in making their moves because they're kind of looking at past data, not future data. And especially they're getting into trouble right now because the data that they've been using to make these decisions have been revised so heavily that they're having to reevaluate even after they've made their decision. So that's kind of what's happening on that. But investors, when they buy these treasuries, that price drops and the yields rise, or they do the opposite. And right now, I think what's going to happen is that as interest rates and the mortgages drop, more and more buyers are going to come off the shelf. They've been waiting for lower rates in order to jump. That's going to increase demand, even though that right now in Orange County here, we've seen a little bit higher inventory, which is great. Buyers have more choices and stuff. But as those interest rates drop, more and more buyers are going to come off the shelf. And so we're going to have a little bit more of a market where buyers are looking for deals and stuff like that because they have lower interest rates to do that, and they've been waiting for that. So increased demand. So you're going to see the housing market remain really strong in that case. So hope that helps you out. If you have any questions, drop those comments in below wherever this is done.